All right, so now what we're going to do is we're going to pick up where we left off, and we're going to begin the process of doing the as-is valuation of Coke. And this will involve using the Bloomberg terminal. So the idea here is that what we're going to have to do in our model, while I wait on Bloomberg to start up, what we're going to have to do here in our model is we're going to have to create our own forecast for the cash flows and therefore the income statement and balance sheets of Coca-Cola for the next decade, right? Because we have 10 years to forecast, and then we have the continuing value assumptions. So here's the thing. In the real world, there are people that cover Coca-Cola for a living, that forecast Coca-Cola for a living, that probably know more about that forecast than we do. These are the sell-side analysts. So what we're going to do is we're going to piggyback initially on the sell-side analyst forecasts rather than creating our own, right? Because this is the whole point of the consensus. The consensus of the professionals on Wall Street is available to us through Bloomberg Professional, and I don't think we're going to come up with a better forecast than the consensus, right? So we're going to start with the consensus. Right? We can always choose to change it later, but when we do our as-is valuation, it's also important to remember that most firms that do this are going to be some plus or minus against that consensus. So therefore, even the firms themselves that are creating their own forecasts are going to have some idea of what the consensus is and how they're doing against that. So what that means is if I go to Coke in Bloomberg, K-O-U-S equity, and the screen that I'm going to want is under earnings estimates, under the research estimates, and the short code is EEO for the consensus overview, earnings estimate overview. Right? And we'd referred to this screen earlier in the semester, but this is very important because by default, it goes to the quarterly consensus, and again, drop down annual consensus is what we're going to care about. So this is the actual data for Coke for 2013, and here are the next 4 years of forecast. But what you'll start to notice is that the number of analysts that forecast Coke in years 3 and 4 drops significantly. Right? So it doesn't mean that these analysts haven't forecast Coke in 2017. It just means that because every data point is publicly tracked, they're less willing to publicly put themselves out there for years 3 and 4. So they tend to be more heavily forecasted in the first 2 years than years 3 and 4. But you can still see 4 years worth of quote-unquote consensus. But I would say that from our perspective, the first 2 years are going to be the most important to the valuation. So really what's going to matter is the next couple of quarters and the next couple of years. So we're going to start with the yearly view. Now, let's go back to our model. This is the share price, which is based on free cash flow. And if you go back to our valuation, I'll use the DCF valuation, you can see for Coke, what matters most is the operating value, right? So it's not the non-operating value, it's the operating value. Well, the operating value is based on free cash flow. So really what's going to matter in our forecast is what drives free cash flow. So if we go back to CFI, what drives free cash flow is gross cash flow minus gross investment. Well, what drives gross investment and gross cash flow? We'll start out with gross cash flow. Well, what drives gross cash flow is no plat. Okay? So let's go back to our ratios and figure out what is going to really matter that's going to affect no plat. Well, one thing that's going to really matter that affects no plat is, I'll make this green, tax rate. So that's one of the key drivers of our free cash flow valuation is what is the tax rate going forward. Another key driver is the cash profit of operations, which is our forecast of EBITDA. That's why in the real world, EBITDA is so critical, because EBITDA is the cash profit from operations of the business, and therefore a key driver of free cash flow, because depreciation is a non-cash item. And then the final driver that matters to gross cash flow is revenue growth rate. How much that EBITDA, therefore proxy by revenue growth, is going to grow over time. So if you really want to boil it down to it, the assumptions that matter most to your valuation are those three: revenue growth rate, EBITDA margin, and tax rate. That's what matters. Okay? 80-20 rule. Now, we can forecast every other item on here, but I'm telling you, forecasting a non-cash item isn't going to have a big impact on our valuation. It has a slight impact on taxes, but the real impact is going to be what happens with our EBITDA. The other thing is our gross investment. Here's what we've set up with the balance sheet. Every one of these items is a percentage of sales. Therefore, when sales grow, so do the dollar values of each one of these items, because everything's a percentage of sales, since the percentage of sales stays constant. That creates the concept of gross investment, because gross investment is the change of this year's invested capital versus last year's invested capital. So if invested capital grows because revenue grows, then we get positive gross investment. So basically, by forecasting revenue growth rate, we are forecasting the balance sheet, because we've tied these key balance sheet items, the operating items of the balance sheet, to revenue growth, which is key for free cash flow. That's why I picked those items to forecast in the balance sheet, because what we're primarily forecasting in the balance sheet are the items that are part of operating invested capital and therefore part of free cash flow. So essentially, what we're assuming by leaving these ratios the same is constant productivity. So what we're saying is growth at constant productivity will give us investment at constant productivity. If you believe that the productivity should change, you can change these percentages. But if you leave these percentages alone, then you assume constant productivity. Most analysts tend to assume constant productivity because it's too hard to predict changes in balance sheet productivity at most firms. Now, there are exceptions, but I'm saying as a starting point, if you really want to look at, of all the things on this page that matter to our forecast, 80-20 rule or even the 10-90 rule, it's those three. So that's where we're going to start with our valuation. And what matters is for the next 2 years, the consensus. So we need the consensus for the next 2 years. So here's the thing. First, we have the tax rate. Start out with the easy one. Well, we need a realistic tax rate for Coke going forward. We did the average of the last 6 years, and just looking at the data, I think 22.3 seems reasonable to me, given what they've been paying for the last 6 years. So an average of the last 6 years seems fine. Now, if I thought that this was truly an outlier, then I probably should do a different number than 22.3, right? But I think that that's probably reasonable enough that, that's what I'm going to use as my tax rate. But we have to come up with what we think is a reasonable tax rate forecast. I'm going to assume 22.3 is reasonable. Next, we need EBITDA. Well, here's the thing. If I go to the EEO screen in Bloomberg, guess what I see? So I basically can pull the EBITDA forecast from Bloomberg rather as a starting point. So that's what we're going to do. So what I'm going to do over here is I'm going to go back to my assumptions tab, and what I'm going to do is I'm going to do two forecasts. One is I'm going to use the forecast for EBITDA, and two, I'm going to use the forecast for sales, because that's going to help me with my growth rate. So sales, EBITDA. And actually, here's what I'm going to do. I'm going to call this sales 1, sales 2, EBITDA 1, EBITDA 2. Now, what does 1 and 2 mean? Convention. EBITDA 1, first forward year. EBITDA 2, second forward year. Sales 1, first forward year. Sales 2, second forward year. Okay? So basically, that would be 2014 sales, 2015 sales, 2014 EBITDA, 2015 EBITDA, and what I'm using is, as a starting point, the consensus. So sales 1, right off the EEO screen, and I'll use the number here today, 47068. Actually, instead of green, I wanted to make this yellow. It's 47068. Sales 2, 48912. Ebitda 1, 13302. Ebitda 2, 14125. Okay, that's the current consensus for the next 2 years. So, here's what I'm going to do. On my ratios, I need to change the revenue growth rate and the EBITDA forecast for these next 2 years. Okay? So, since I'm going to pretty much always use this idea of consensus, then what I'm going to do is I'm going to solve for it directly here on the ratios tab, and I'm going to not make these two in yellow anymore. And so here's the way we're going to do it. Is equals, what is percent change? It's current year minus previous year divided by previous year. So current year for 2014 is the assumptions for 2014 sales, sales 1, minus previous year from the income tab, 2013 actual revenue divided by 2013 actual revenue. So basically, the consensus for Coke suggests about a 0.5% increase in revenue. Right? So by solving for that percentage change, then in my model, the income tab, which matters, 46854 now matches. So let me try this again. What did I just do? Oh, sorry, 47068 now matches the 47068. All right, so if Coke grows that percentage, because it's this percentage change that gets me to that growth rate, that gets me to that dollar amount, then that's what would lead to the model matching the consensus. So I'm basically solving for it. So rather than iterating for it, we're solving for it. Right? I'm going to do the same thing for 2015. So equals, left paren, from the assumptions tab, sales 2 minus sales 1 divided by sales 1. So the market is expecting Coke to grow 0.5% in 2014 and to grow 3.9% in 2015. And that means that 47068, 48912 matches 47068, 48912. So all we're doing is we're just coming up with a way of putting in the consensus sales numbers into our model without directly typing in a number into the income tab. Because remember, the income tab we want to be repeatable as we update the data. That's why we're doing it this way. So we're solving for the percentage change in the first 2 years. Questions? Okay. So here's the next thing. What we have here for equals forward year 1, so 2013 plus 1, and forward year 2, is we also have the EBITDA consensus. Call it the Ebitda margin. Which means in 2014, EBITDA 13302 divided by sales says that that's going to be 28.26%. And in 2015, EBITDA 2 divided by sales 2, the Ebitda margin in 2015, 28.88%. So what we quickly see is that the analysts have essentially forecasted for Coca-Cola an Ebitda margin. They've given us the dollars, but essentially it can be quickly converted into a percentage. Right? So here's the thing. I want these percentages to go into my ratios tab right here. Okay? So I want this percentage to be that percentage. Okay? So what I'm going to do is I'm going to say equals, from my assumptions tab, that percentage, and equals, from the assumptions tab, that percentage. And I'm going to make those cells white. So what I'm basically doing is I'm using the consensus EBITDA and the consensus revenue growth rate for the model. Now, the way the model is solving for operating expenses is it's backing into them by taking I6, which is EBITDA, minus I4, which is gross profit. So the model is basically going to adjust the operating expenses based on the EBITDA number that we are putting in. So it's basically going to either raise or lower the operating expenses, the SG&A. All right. Now I want you to understand that that's a cheat. All right, and here's what I mean by that. Because technically, if the EBITDA changes, it could be because the cost of revenue is changing, or it could be because the operating expenses are changing. And it's probably a combination of both. Go back to your midterm exam. On your midterm exam, when you did the ROIC tree analysis, you had to explain the gross margin and the SG&A to explain changes in operating income. So both of those would actually be changing. And I'm cheating because I'm only changing the operating expenses here. I'm not changing the cost of revenue. Everybody see that? But here's the point. From a cash flow perspective, it doesn't matter, right? Because revenue minus cost of revenue minus operating expenses equals EBITDA. So revenue minus cost of goods sold minus SG&A equals EBITDA. So from a cash flow perspective, there's no nuance to the model, meaning the model cares about your EBITDA and it really doesn't care about the two buckets of cost above. In the real world, companies care. So if you were forecasting this for a real company, you would do a separate forecast for gross profit, you do a separate forecast for SG&A, and then you would get an EBITDA. But what's going to matter to the model is that EBITDA. So that's why I said I'm using EBITDA as a proxy for changing both by only changing one. Okay? Does everybody understand what I just did? Just for simplicity? Because from a valuation standpoint, this is the number that's going to matter in our gross cash flow. So I'm just keeping it simple. We could have easily set up the model to adjust the cost of revenue. I just chose arbitrarily to affect the operating expenses. So that's also why I'm not doing an ROIC tree in the future, because the ROIC tree in the future is a little bit more arbitrary versus the ROIC tree in the past, because I'm only affecting operating expenses. I'm not affecting cost of goods sold. And that's what I said. In the real world, people will focus on both, because gross profit is a leading indicator of what's going to happen to your EBITDA. But we're skipping over that part for simplicity. So again, notice by putting in the consensus, what has happened to the share price of Coke? Why?
Well, EBITDA increased 2.3%.
Yeah, EBITDA is higher, and therefore what? With a higher EBITDA, why am I getting a higher share price?
Higher free cash flow.
I'm getting more free cash flow. Why else am I getting more free cash flow?
Because your revenue's not contracting, it's expanding.
That's right. My revenue's not contracting, it's expanding. So the analysts are predicting two things. Coke is going to start growing, or before it was shrinking, and Coke is going to grow at a higher margin, therefore generating more cash flow, therefore adding more intrinsic value to the firm. So on an intrinsic value perspective, we're at 49.03. Notice, much closer to the current share price. All right? Everybody with me? All right. So what I'm doing here is I'm creating a version of the model, which I'm going to save, and I'm going to call this the baseline. Baseline is a term that has no meaning beyond this class. Right? So if you talk about baseline with anybody else, they're going to look at you like you're nuts. They're going to not know any idea what you're talking about. But here's the point of what I'm going to call the baseline. The baseline basically says we have put in all of the assumptions from the analysts, and we have put in all of the historical data from Coke and all of the market data, things like cost of capital, etc. And now we're ready to do the as-is valuation. So we've pretty much set the model up to do the as-is valuation. I'm calling that the baseline. Right? So it's really an intermediate step. But I'm just saying that to do the valuation, you pretty much have to get back to this point. You have to put all the data in for your company. Now you're ready to do the as-is. And as part of the as-is, so that's the first valuation of two we're going to do, as-is and then final, we're now going to try and come up with why is Coke worth $42 a share. Right? Now to help us with this, we need to use real-world data. So one of the things that we'll do is we're going to go to the portal and we're going to go to IBIS. And the reason why we're going to go to IBIS, and there are other data sources you could use as well, but in IBIS, where's that? Here it is. They do industry reports. And as part of the industry reports, one of the things that they include is an industry forecast for Coca-Cola's business. So obviously we probably want to use multiple sources. And again, this is something that if you do this professionally, you should have access to, is that you'd look at a lot of different sources for growth of the company that you're looking at in the industry level, longer term. But for our purpose, we're going to use IBIS World as a proxy. So in IBIS, you can type either in the industry or type in the company. So I'll type in Coca-Cola, hit search, and this will tell me the industry reports that they're in. And since Coke is a global company, I'm going to use the global report, global soft drink and bottled water manufacturing. And I can either look at it online, or if I want, I'll save this as a PDF to my hard drive. That way I'll post it later to Canvas. But here, one of the key points is if I look here at the industry outlook, then it'll talk to me about what's expected to happen in the industry. And if I go over here to key ratios, then with the industry data, one of the things that they show here is industry growth rate. Here's the revenue growth rate expected for the global beverage industry, 2014 to 2019. So 2.9, 3.6, 3.3, 3.7, 3.4, 2.9. So I'm not saying Coke is going to grow at those rates, but I should have at least some idea of what the industry is growing at for the company that I am looking at. So I might say Coke is growing faster or slower based on competitive advantage, but nonetheless, and we're there in their market conditions, but that should be my starting point. So let's go back to Coke. Here's the thing. What do I think the market is going to say for Coke's growth going forward? Well, if I do look at the growth rates, I can just switch here in Bloomberg, and I look at sales, the next 2 years, which are lightly forecasted, suggest at least decent sales growth by the analysts that are putting it in there, a little bit faster than the industry. So if I come back here to my model, I now have to start figuring out what I think the growth rate should be in the future. So 4%? Do I think it should be higher or lower? Anybody have an opinion on that? Starting in 2016? The industry is expected to grow at where is it? 3.3? 3.7 the next couple of years? 3.4? So where do I want to set Coke?
3.5, 3.6.
All right, 3.5, 3.6. And notice, because everything equals the previous year, it carries it forward into the future. But I think growing around 3.5% probably is not an unreasonable assumption. But here's the thing. That works out to a $47 share price. Now, we can argue and debate around the margin what Coke's longer term growth rate is, but I think Coke would probably at least grow with most economies, and Coke is diversified outside the U.S., so I think growing a little faster than the U.S., 3% probably makes sense. You know, is it going to grow at 10%? Probably not as a bigger company, especially because they're having some challenges with the market. But I think somewhere in the 3.5% to 4% range probably seems reasonable. So here's the thing. We got to get down to a $42 share price. How do I get there? What's the other variable that I'm going to have to change? Ebitda. So what we're starting to see is Coke going to be able to sustain their Ebitda margins based on the current share price? Likely no. That's what we're starting to get a picture of, is that with moderate growth, a little bit above the economy, a little bit better than what IBIS is forecasting for the global soda market and beverage market, that Coke still probably is not going to maintain the margin improvements it's getting over the next 2 years, right? So basically, I'm going to have to start lowering my margins. Now, I don't want to start lowering my EBITDA in 2014 and 2015. Why not?
Because that's already forecasted.
That's the consensus. So it's really in the outer years. So in this case, 28.9, and I can go back and look at a guide. I can see historically they were high as 30 and as low as 26. So what if they go back towards this number? What if they get down to 27? And then what if they get a couple years later to 26.5? If I change my EBITDA from 27 to 26.5, which is around where they were in 2012, I'm at a $43.22 stock price, which, by the way, Friday close was $42.19. So I'm relatively close. So basically what I'll say is instead of 3.5 by 2018, what if it's 3? What if I get a little lower growth in the future? There's not a right answer here because obviously I can play a little around with the growth and I can play a little around with the margin. But what I'm trying to get a sense is the range and the sensitivities. And what I know is Coke is looking at low single-digit growth, and they're probably looking at short-term increasing margins, but those margins are probably not going to be sustainable in a more competitive global market, so they're probably going to see some erosion of margins, particularly their EBITDA margins over time. Is it going to collapse? No. Their share price doesn't suggesting a collapse, but it doesn't show that they're going to sustain what they have in the next 2 years. So therefore, that is my file. Save as is scenario for Coke. I'm now within $1 a share. I now have and this is the key word, story. You have to articulate a point of view. Notice that as I was coming up with the share price of Coke, along the way, I was articulating every assumption. And I was articulating every reason that I made that assumption. That is the way that I'm going to grade you on your group projects. Because for the companies that you guys are forecasting, Coke and Merck and Pfizer, you can't tell me and I can't tell you whether you're right or wrong. We're looking in the crystal ball here. So the only thing I can really grade you on is the reasonability of your assumptions. So how did you come up with the assumption? Is it reasonable? Do you have something to back it up? At least with the Coke data, I can back up the revenue growth rate with a reference to an industry report. I can back up the margins based on historical data with a little color commentary about what I think is going to happen to their margins in the future with the extra competitiveness that I see in the marketplace. That's what you're going to have to start to develop. This is the art of valuation. And what matters to the art of valuation is your assumptions. How good are you at understanding the assumptions and how they're created? The numbers themselves can be a mathematical exercise, because that's the point. You can very quickly adjust this spreadsheet to get to $42 a share, right? But that doesn't mean that you have a very good understanding of what's happening with Coke. So what really separates the good analysts from the mediocre analysts are the ones that understand where these assumptions are coming from, where the mediocre analysts, it's just a mathematical exercise. I can plug in numbers to get me close to the share price and say done, right? But that doesn't mean you understand why you came up with the numbers. So that's what you have to do in the valuation. So the way your group project valuation is set up in both the PowerPoint and the written paper is that you have to do an as-is valuation, and as part of your as-is valuation, you're going to turn in your model. I'm going to see your as-is model, but then you're going to have to tell me what assumptions you changed. Now, again, we're primarily focused on growth and EBITDA. All right, I haven't even touched the productivity of the balance sheet because implicitly I'm saying I think Coke's productivity isn't going to change. If, however, I did think Coke's productivity was going to change, I could put that in. If I thought they were become less efficient on their net fixed assets, I could put in 35% and then see an impact on the share price. All right. Generally, I'm not going to do that. And I'm going to focus mostly on the gross cash flow side of the free cash flow and talk about what I see happening here, but nonetheless, that's what you're going to have to do. That's the as-is valuation. So what we're really trying to get understanding is not do we agree with the assumptions, but what must the market have been thinking when they value them at $42 a share? Because as I said, if Coke, if we really want to understand Coke, what we're really trying to do is reverse engineer the insight of these people. It's the 62% institutional ownership of Coke. And these institutions went through the MBA programs that you're going through, and they're learning the exact same things on a cash flow basis that you're learning, and so they're using similar models. So that's the point. We're just trying to reverse engineer what must be in the average model, right? Not whether we agree with it, and that's very important for the as-is valuation, because so many times people will say, well, I don't agree with this share price. I think Coke is worth something different. It doesn't matter. This is what it's trading at. So we have to understand what cash flow justifies the current price. That's what we're backing into in the as-is valuation. So now we do valuation number 2. Once we come up with what we think is a reasonable as-is valuation, then we'll do what we call a final valuation, right? Which basically means now we're going to put in our own point of view. Now we're going to make our own assumptions for Coca-Cola. So I'll go back to the model, and I've got the as-is. So now what I'm going to do, File, Save As. Final. Right? So what do you guys think? Fairly priced, underpriced, overpriced? What do you think about their revenue growth prospects? What do you think about their margin prospects? Too conservative? Should they be higher? Should they be lower? Anybody have an opinion on that? Yeah.
I'll take a stab at this. And I can use like my outside process.
You have to.
Okay, cool.
You have to.
I believe that the revenue growth rate is not going to be as high as the 3.5%.
So give me a year.
Let's say 2017.
Okay. Give me a number.
3.9.
Okay. And then in the future, does it stay at 3.0? Does it go lower?
I would say we changed it from 2018. Oh, we changed it to 2017. Maybe 2.7.
Starting in what year?
2019.
Okay.
Because I believe that with the latest trends in health and fitness, people are going to start to decrease the amount of sugary products that they consume, go with more healthier options, and unless, they take a huge maybe stake in some healthy drink option, that they're going to see their their sugary products decreasing.
Yeah, this is one of the reasons why I think it's important to follow the news in the real world, because the news is what gets you educated as investors about these things. And I clip a lot of news articles to Evernote and I post them on Twitter. But I remember seeing here, go to Diet Coke, this article from the spring on April 2nd, which I clipped to Evernote, which talked about the decline, and this was for the US, but this is the first quarter decline in revenue of diet drinks. And so one of the things as we're going healthier is that Coke and Pepsi had tried to insulate themselves with healthier by pushing diet sodas. But the research is now starting to look like there's a possibility that diet sodas are just as bad, if not worse for you, than the original sodas themselves. And for whatever reason, sales of diet sodas are starting to fall dramatically. So when you think about the healthcare trend that you mentioned, that's becoming a real revenue inhibitor for Coca-Cola. Because basically as people are moving away from soda and they're moving into other beverages, they're staying away from diet and they're starting to go to other things. Unfortunately, Coke is just not as strong in the other things. So it doesn't mean that they don't necessarily have opportunities to go in. And by the way, if you become an investment banker, this is how you get your inspiration to then go to pitch to Coke about the next great company that you should be buying. So that's why you got to buy Monster, or that's why you got to buy Monster Beverage, or that's why you had to buy this water company, because there's this giant water shortage, and obviously you can capitalize on that, and Dasani is just not good enough, because everybody knows that Dasani is Coke's water. By the way, what actually makes Coke's water differentiated is they put salt in it. That's the difference between Dasani and Aquafina. So Coke actually puts in minerals, and the mineral is salt, sodium chloride. So it's basically just tap water with some salt in it. But in any event, so back to this. They need more than that if they're going to succeed in the future. So you could actually make a case that their growth could actually be even more tepid than what you're saying. But given your growth scenario, what's going to happen to their margins? So let's go back with that. Go with your story. What do you think is going to happen to their EBITDA? And right now we're saying it's getting to basically where it was in 2011, 2012, 2013, before they started improving it. 26.5. Do you think they'll maintain 26.5?
No.
So give me some numbers.
So let's see. It's, I feel like I'm like shooting in the dark. So we could reduce that in 2019 to 26.
Okay. Reason? I can give you a reason. Lower growth, more competition, lower margins. How about that?
Sure.
All right. Matter of fact, why don't we reduce it in 2017 a little to that number? Be a little bit more pessimistic in our scenario. So they're at 26 going forward. And then maybe it gets even tougher when it gets down to 2.7% and this goes to 25. Okay, just potential scenario. Now here's the other thing. We're at 2.7% revenue growth rate in 2024. In our assumptions tab, we have a continuing value assumption for the long-term growth rate. If we're saying for the next decade 2.7, beyond that, do you think they're going to suddenly jump to 3? So very, very long-term growth rate for Coke, maybe instead of 3, maybe 2.7? Or 2.5 even? Well, now, 37.61 a share is what we're saying Coke is worth, assuming that that point of view scenario comes in. So we're going to use a 10% plus or minus. So 10% below the current share price is a sell. So now Coke is in the sell category. So what you've really just articulated with some of the nuances that I've just added is you have basically done a sell scenario for Coke. Stay away. All right, Warren Buffett, time to get out. You've been there for too long. Time to move on to the next soft drink, next beverage maker.
Move to Pepsi.
Or, as I said, we can go back to our baseline, or sorry, our final valuation, which was the as-is valuation, starting point. And we can be a little bit more optimistic. And we can say, you know what? Coke has an amazing management team. Every time you count them out, they just seem to persevere. They figure things out. Meaning they faced this challenge 20 years ago when they got into diet drinks. They faced this challenge a decade ago and they started getting into water and fruit beverages and juices and stuff like that. They're going to figure out a way to grow. And they're going to figure out a way to maintain their margin because there's just such a great global brand. And they're going to get a way for people outside of the US and Europe to drink even more beverages as they become more wealthy and they put more stuff in their diet. And we're underestimating that with some of the tepid growth they're seeing this year. So I am bullish on Coke, and I think that Coke might actually grow a little faster at around 4.5% and maybe even 5% as international markets grow faster. And I think that as a result, that they are going to maintain decent margins with all of this extra growth. So instead of 27, I think it's 28. And I think that that will continue a little bit less than what they're doing in the next 2 years, but a little bit lower, or sorry, a little bit higher than what they've done historically. And you know what? Buy Coke. Coke is undervalued. There's immediate and present value close to 20% upside in Coca-Cola stock. That is my buy recommendation on Coke. And by the way, in the real world, if I go to the analysts, you'll notice not everybody says buy. There's a bunch of people that say hold or sell. So there's not complete agreement because, again, we're dealing with the future. So what I'm telling you is I could have two groups presenting to me final presentations on Coca-Cola using the same data, come up with two separate conclusions, and you could both get a good grade because it's really your point of view and whether or not you can make a reasonable point of view that's defensible. And I think you can make either scenario come true in the real world. That's why you don't see complete consensus in the analysts, and that's just a question of which one you think is more right. So you can make three scenarios. Coke is fairly valued, Coke is undervalued, Coke is overvalued. Which one do you guys agree with? Because it goes back to your comment during the break, which is I want to manage my own money. You got to have a point of view.
It's as is.
You like the as is? You think they're fairly valued?
Yeah.
No,
So before you do, why do you think it's the as is? Why do you like that scenario the best?
I think the assumptions we made in the beginning were fine as they are. I mean, it's going to go at the steady state.
Okay,
If
so
we achieve the equilibrium level, is what I feel.
okay. Again, it's not a question of right or wrong. This is an opinion. Anybody like the bullish scenario? Anybody think Coke's a good buy? They still got upside?
I would. I want to know what's going on with their expenses now. Those are increasing so much over the past 3 years.
By the way, that's why the analysts on the quarterly call start asking those questions. And that's exactly where the questions start coming out to management if you're an analyst. What's going on so that you can actually figure it out. And one of the things that Coke announced, and again, this is why it's important to do readings of the current press, is when they announced their earnings, which were tepid, and their growth, which they said was a little bit lower, they also announced $1 billion worth of cost cuts. So basically, that's one of the reasons why their margins are higher, is they're slashing expenses to basically make up for the fact that in the short run, they're not getting the growth. But what they're promising is, despite the slashed expenses, that they're promising that growth will return. So that's what they're saying. Whether you believe them or not is a different story, but that's where the buy-side scenario comes into play. Anybody think they're a sell? Yeah.
I think the operating model has changed so much with the way that they essentially started off as a brand that just sold a really simple, easy to produce product. And now they've had to vertically integrate into all levels of the value chain. I don't see them getting back to being the company that they were if that trend continues, unless they just figure out a way to, again, divest from those assets and get back to a model where they have higher margins.
Okay. So again, any of these scenarios could come true, and that's the point of what we're trying to do. I also find it helpful to actually do the buys and the sells. Meaning, even if I don't agree with the sell side scenario, I would still run it as a sanity check towards my buy. Because I kind of want to know what could happen to a company as opposed to doing the sort of dynamic, the dynamic analysis as opposed to doing just the straightforward, this is with certainty what I think is going to happen. Because it helps you kind of test your point of view and really make sure that you're more comfortable with the assumptions that you're making. So, even for your group projects, all I'm going to ask you is to give me and that's the point, 2 valuations. You're going to turn in 2 Excel models. You're going to turn in your as-is, you're going to turn in your final. And in your PowerPoint and in your write-up, you're going to write up the assumptions that led you to your as-is, and then you're going to write up your assumptions that led you to your final valuation. And then you're going to include in your model what I call a sanity check. So, what do I mean by that? I'm going to take the buy scenario, and I'm going to make this kind of our final model. So what is the sanity check in our final model? Well, a couple classes ago, go back to our lecture notes, there was this slide. And this was the McKinsey ROIC decay slide. It basically said no matter what your ROIC is, it tends to regress towards the mean over a long period of time, right? So that should be our bias. Our bias, not saying there can't be exceptions to the rule, but our bias shouldn't be that ROICs move in this direction, right? So here's the thing. Have we forecasted ROIC in our model?
Yes.
Oh, yeah.
Yes, we have. It's in the EP tab. So what we're going to do is we're going to go back to our model, and we have to choose which ROIC we want to use. Do we want to use ROIC based on beginning of year capital, so current profit over last year's capital, or do we want to use ROIC over end of year capital, which is profit divided by this year's expenditures? What do you think is probably more realistic to our cash flow? Probably the average of the two. But since we don't have the average of the two in our model, which of the two would you choose? I'd probably use the end of the year. So even though I did beginning of the year, and again, just to be really clear, the reason I chose beginning of the year was arbitrary because I wanted the economic profit and the DCF to balance. But you'll notice when I did the tree, I did based on end of year data. And when I do the ROIC check, I'm going to do it based on end of year data. That's why there's 2 EP tabs in the model, just so you know. So we have a before and after the investment. So here's what we're going to do. We're going to take this ROIC in the end of year tab after goodwill, which is row 15, and I'm going to make it a graph. Insert a chart. In this case, in the Word version, the PC version, I don't think you can do as a chart sheet. In the Mac version, you can do as a chart sheet. So you can put it as a chart in your model, but I'm going to graph the ROICs, historical and future. And I'll make it a line chart. But what I basically have here is select my data, take my x-axis labels from 2009 to 2024, and I have what I'll call the ROIC chart. That's the ROIC chart of the buy scenario. What's that basically saying? that the operating ROICs, which last year were 25, have to approach 35 by 2024. Then, and I should have done this before I had created the buy and the sell. Oh well. So I go to my sell model, and I'll take the EP, EOY, and I'll take the same ROIC, insert chart. This is the ROIC of the sell scenario. Buy, sell. Which one looks more reasonable to you? So my bias on Coke, if I had to actually pick, is I would not be investing in Coke today. I'm not saying that the analysts won't prove me wrong. And that's what I said, Wall Street's a game. It's a momentum game in the short run. It's an expectation game in the short run. In the short run, the fact that they're beating their estimates and lowering costs and laying off people and having good comps may not drive the stock price higher. But if I'm looking at Coke long term, then the idea that ROICs tend to move down, not up, over long periods of time suggests that as they mature, they have to become that much fundamentally better than they are today, which is against the grain. And I'm not saying they can't pull it off, but I'm saying if I had to choose between the two, I'm going to be more biased towards the hold sell side than the buy side, because the improvements in ROIC that they're going to have to get that buy scenario are very high. And maybe just structurally, they're just going to boom in international markets, but I have to believe that in international markets, there's going to be a lot of competition there. And maybe they don't have a stronger brand in India as they do here in the US, and it's going to take a lot more investment over there to get that sales growth. So again, not saying it's right or wrong, but this is the other thing you're going to have to show me as your final part of your valuation. So your final slide in your PowerPoint, your final chart in your group write-up is going to be this ROIC chart. And as part of the ROIC chart, you got to defend it. So here's my as-is valuation. Here's my assumptions why. Here's my final valuation. Here's my assumptions why. Here's my buy, sell, hold opinion that comes out of that. And oh, by the way, here's why it's believable. So you just got to put this chart up, and it's got to pass the believability test. So I'm not saying that this can't be believable, but you got to have a really good story. So for example, the people in the EIC section of your group should be saying what? If I believed in the Coke buy story, what should the EIC section be saying?
The industry's getting more attractive.
Yeah, the industry's getting a lot more attractive. Or Coke's competitive advantage is just catapulting leaps and bounds against everybody else. And they're just going to get an increasing share of this market. And if I don't say one of those two things, then I don't really have a compelling reason to explain this. Right? So, because again, what's competitive advantage? I can live without the cost and still maintain my margin. So I can have less people or less marketing dollars and still sell as much as I'm selling. Or back to the point, I'm getting all of these sales and all this market, and I'm going to grow and ride this wave. And there's this really big wave coming, and that's what the market is picking up on, and therefore they're going to get a lot higher growth. Or I don't see a wave. I see equilibrium sales. I see a mature market, and I think in a mature market it gets tougher. And this actually makes more sense in a tougher market. So that's what I said. That's what you got to defend. Got to pass the reasonableness test. Questions?
Okay, not on this thing, but going back to the price projection, right?
Yep.
So can you do a 1-year projection and a 5-year? Yes, you can, right?
Mhm.
Right? By using the 1-year continuing value and all that. Okay.
Yep. Now, here's the important thing to remember in all of this, which is even when we present value this, because we're using a weighted average cost of capital, and in our weighted average cost of capital, we are discounting at 7%, 7.2%, but that's assuming a cost of equity of 8.5%. What it actually says is that at a $42 stock price, as a shareholder, you're going to make 8.5% a year. So the stock price of Coke is going to go up by 8.5% this year. Or between dividend and stock price appreciation, you're going to get 8.5%. But that's the point. You're still going to make 8.5% as a shareholder owning Coke because it's fairly priced. You're just not going to make more than what you expect. And back to economics, value is about doing better than expectations. So you're going to earn your cost of capital, which means Coke is still going to see some price appreciation. So even if I do a 1-year price target, Coke's 1-year price target is probably, if they're 42 today, it's 45 for me. So I'm not saying you're not going to see a price appreciation, but that's built into the concept of discounting because the present value of 44 or 45 in a year is 42 today. We're doing a present value. So essentially, if you say hold, you are still getting price appreciation in the stock. You're just not getting more than what would be expected given a cost of capital. It's an important financial nuance that sometimes gets lost on people because people often think hold means the stock price isn't going to change. No, the stock price is going to go up. It's just going to go up as expected for this amount of risk. You're just not going to do better than that amount of risk in the market. So that's why there's not really a real reason to do this. So what I would say is, at this point, you're better off in a diversified portfolio. Because in a diversified portfolio, if something goes wrong, then you got many other stocks that earn this amount of rate of return that insulate you. If something bad goes wrong at Coke and all you own is Coke, you're kind of screwed. So hold often means to me, I'm better off in the market than I am in an individual company, right? Versus buys, I'm actually interested in the individual company because I think they will outperform the market basket because there's a mispricing going on here, which is another way of saying they have alpha. Buys are alpha. If you really think about it and you want to tie it back as metaphorically back to your portfolio class, right? So that's what you're really saying when you have a buy, is that you see a company have alpha. Why would a company have alpha? Competitive advantage or good market. They got to be better. And so therefore they're going to have to do something that sustains this. Make sense? All right, I'm going to pause this video here, take another quick break.